But I want to touch on the market outlook for this week because we have a lot going on the last week of July. And I want to fully touch on the total cryptocurrency market cap, levels I'm paying attention to, not only in the total market cap, but also in regards to XRP, Canton, giving you guys some updated levels on metal and XPR as well, because the dark pools have been super accurate on all of those pairs across the board. So before we get into the TA real fast, let's just align ourselves with the outlook. We can skip the weekly recap from last week. Remember, I mentioned to you all in the weekly recap that last week was risk off. So now we can get into the weekly outlook for this week. So starting off, I said this week, the market's attention will be centered on five major themes. Number one, the developments, of course, in the Middle East. We have Israel's Prime Minister Benjamin Netanyahu, probably butchering his last name, but you guys know him, right? Visit Washington. He's going to be visiting Washington, I think Tuesday or Wednesday, if I'm not mistaken. If not, it'll be later in the week. So we'll be looking for any announcements on that regard. Number three, the Federal Reserve's policy decision and other major central banks like the Bank of Japan. Key U.S. inflation data. We have core PCE. And we also have, of course, as NASDAQ traders, earnings reports from major tech companies like Apple, Amazon, so on and so forth. And that will have a major impactful role on price action and sentiment this week. So together, these events will likely determine whether risk assets can stabilize the current sell pressure or whether another wave of risk-off sentiment develops. The biggest driver remains right now the Middle East. By the end of last week, both crypto and equities had already priced in a significant amount of geopolitical risk, with the total crypto market pulling back sharply while the Nasdaq sold off aggressively into lower institutional pricing levels. Over the weekend, we know that markets received the first sign that the conflict may not be accelerating at the pace investors had previously feared. After nearly 2 weeks of continuous bombing, the United States paused its airstrikes on Iran over the weekend, ending a streak of 13 consecutive nights of military operations. At the same time, diplomatic negotiations continued behind the scenes as mediators attempted to prevent the conflict from expanding into a broader regional war. Officials involved in the negotiations indicated that both Washington and Tehran remain interested in returning to an interim ceasefire agreement. And if we got that, that would obviously, of course, be bullish. But we know that that's not the case as of time of recording, with discussions reportedly centered around reducing restrictions on commercial vessel traffic through the Strait of Hormuz. Iran also confirmed that technical negotiations with Oman continued throughout the weekend regarding maritime security and shipping throughout the strait, while no formal agreement has been announced. The continuation of negotiations suggests that diplomatic channels remain open despite the ongoing military conflict. However, markets remain far from convinced that the situation has been resolved. President Donald Trump continues to send mixed signals. While emphasizing that negotiations remain active, he also stated that the United States is prepared to intensify military operations if necessary, saying that military action could continue dismantling Iranian capabilities piece by piece, those are direct quotes, or escalate much more rapidly if negotiations fail. So again, this week, what do you all think we're going to be paying very close attention to? Reports also surfaced that the U.S. Army is actively preparing contingency plans for large-scale operations against Iran should President Trump authorize them, which would be crazy. We'd probably see a huge risk-off backdrop, and some of those bearish scenarios that are a little bit extensive on pairs like XRP dropping down to 68 to 91 cents would likely unfold if we saw something like that this week. No final order, however, for now has been given, but the military option clearly remains on the table. Adding another layer of uncertainty is Israel's Prime Minister, Benjamin, scheduled to visit Washington this week. You can see that in the little tiny blip of an announcement here. The meeting could prove to be one of this week's most important geopolitical events. Israel has played a much smaller role during the latest round of U.S. operations, despite being heavily involved earlier on in the conflict. Markets will now be watching closely to determine whether the meeting results in renewed military coordination between the United States and Israel, or whether both sides instead prioritize diplomatic efforts. Any indication that military operations could once again threaten shipping through the region would likely send oil prices higher, and we know higher oil prices increase inflation expectations, lift treasury yields, strengthening the dollar, reducing expectations for future Federal Reserve rate cuts, and generally pressure risk assets such as equities and crypto. So, the bullish Middle East scenario this week. The constructive scenario for markets will be, of course, diplomatic progress throughout the week. if the pause in U.S. airstrikes extends beyond operational pauses into a broader de-escalation and negotiations between the United States and Iran and Oman and regional mediators continue making progress, with both sides coming to agreements. Not that conflicting bullcrap where Trump is like, yeah, we're talking, and Iran is like, no, we're not, right? We want to see confirmation. We want to see certainty. That's what markets like. Should Benjamin and the Trump meeting emphasize diplomacy rather than military expansion or action? And if shipping through the Strait of Hormuz remains stable, oil prices could, of course, begin easing from recent high levels. We know lower energy prices would then indefinitely help reduce inflation concerns heading into the Federal Reserve's meeting, along with the core PCE inflationary report towards the end of the week. Combined with reassuring guidance from upcoming earnings, improving geopolitical conditions could allow for both equities and crypto to recover after last week's sell-off and, of course, today's sell pressure. Now, flip that on its head to save time for the sake of this video breakdown. Any major escalations, any new strikes, any confirmation that negotiations are not further continuing, and if Israel gets further involved in the scenario, if ground troops get deployed, if attacks on civilian infrastructure happen, all of those things, of course, would feed into the bearish scenario in a more risk-off driven environment. All right. So be mindful of those if-then scenarios. Beyond geopolitics, investors, we also need to watch a busy macroeconomic calendar. This week, we have the FOMC meeting, which will be closely scrutinized for any changes in the Federal Reserve's outlook. While the core PCE inflation report also remains one of the Fed's preferred measures of inflation, which comes out later this week, any upside surprise in inflation, particularly alongside elevated energy prices, would likely reinforce a higher for longer interest rate environment. Finally, although crypto stabilized into the weekend after last week's sell pressure, we have yet to see how traditional financial markets, so we can go ahead and skip that because we know that the markets opened bullish, but then ended the day today bearish. The Federal Reserve is widely expected to leave interest rates unchanged at this week's FOMC meeting. However, the decision itself is unlikely to be what moves markets. Instead, we will be focusing very closely on Fed Chair Warsh's forward guidance. So when he gets asked the question at the statement press conference, and all the the reporters raise their hands and start asking him questions, that's what we're going to be paying attention to. Does he comment on oil prices? Does he comment on the resilient economic growth? Does he comment on his belief if inflationary figures are going to persist, right? So on and so forth. What is the market sentiment around interest rates after Fed Warsh speaks? Does the market interpret his comments and his rhetoric as dovish, supporting, keeping monetary policy the same? They don't need to keep it restrictive, and that they're in a place to possibly consider cutting interest rates? Highly unlikely, but still possible nonetheless. Or does he continue to feed into the hawkish narrative, push back on interest rate cuts, keep interest rate hikes as a possibility on the table, so on and so forth? Following the recent surge in crude oil, markets have begun pricing in greater probability that the Fed may not be finished tightening monetary policy. Only a few weeks ago, futures markets were assessing roughly a 14% probability of another hike following stronger economic data and rising energy prices. Those odds have now climbed to roughly one-third, showing that investors are becoming increasingly concerned that inflation risks are beginning to reaccelerate, with those odds now hovering at a 33% probability. I'm going to put this in bold. So again, if you've been a part of this community, we know that these percentages tend to change and sway market sentiment. So this week, real quick question, if the odds of rate hikes increase, like towards the end of this week, we see them above 50%, above 70%, or something crazy close towards 100% probability, then what are we likely going to see in terms of risk sentiment? You don't need to answer it. Just again, start asking yourself those if-then scenarios. We're probably going to see continued sell pressure on risk assets. Vice versa, if we see this percentage chance of another rate hike decreasing and we see it going closer to zero or below the previous probability of 14%, which allowed the markets to slightly rally last week, then we could obviously, of course, see some formal recovery start. We know that this shift matters because financial markets have spent much of this year anticipating eventual monetary easing from the Fed. If the Fed signals that elevated energy prices or strong economic activity require rates to remain restrictive for longer, we know that the dollar could continue climbing, while liquidity-sensitive assets such as tech stocks and crypto could remain under pressure. Let's continue. Beyond the FOMC meeting, we have the core PCE inflation, which is the Fed's preferred measure of underlying price pressures. Right now, the consensus or the market is expecting that currently the core PCE is set to increase only 0.1% month over month, which is right now slightly cooler from a previous reading of 0.3%. So right now the market is anticipating that we're going to get cooler inflation. That is very important, okay? Because if we get the inflationary report and it comes out well above what the market is expecting or well below what the market is expecting, that's when we're going to get the algorithms changing hands and starting to price different scenarios in. So personal income is also expected to rise 0.3%, while personal spending is projected to increase to 0.4%, both moderating after stronger gains in May. Markets will also monitor several additional reports, including consumer confidence, employment cost index, the Case-Shiller, Chicago PMI, and the Dallas Fed Manufacturing Index, along with the University Michigan Consumer Sentiment Survey. So we have a very busy week ahead. Now, I gave you guys some bullish scenarios for core PCE. Of course, the bullish scenario would be if core PCE comes in below expectations or at what the market is expecting. Because remember, we got lower PPI, we got lower CPI. If we get lower core PCE, then the market's going to start to gravitate towards the possibility that the Fed could cut rates if we continue to see de-escalation in Iran, US conflict leading to lower oil prices, which will eventually inevitably allow for inflation to continue to moderate, right? So we'd ideally like to see that this week. Flip that on the head, of course, if inflation surprises to the upside or comes outside of or higher than what the market's expecting, be prepared for the markets to reevaluate pricing in interest rates and monetary policy. Last but not least, outside of earnings reports, we do have the Bank of Japan, okay? We know that that is still something that I'm anticipating lingering in the background as a catalyst that could take risk assets much lower than what the market's currently pricing in. Although much less discussed than the Federal Reserve, this week we have the Bank of Japan's policy decision, which could have significant implications for global markets. Now, I will fast forward this. I only see this having a huge implication if the Bank of Japan does something outside of what the market's expecting that leads to excessive yen strength. So right now, I think the market is prepared for a possible interest rate hike or for the Bank of Japan Governor Ueda to put out forward guidance that shows that they're willing to increase rates gradually as time persists. So as long as that remains the case, I don't see any excessive yen strength. But if something like back in 2024 happens, where the market was only pricing in one interest rate hike from the Bank of Japan, markets were preparing for a 25 basis point rate hike, and the Bank of Japan surprised the market and hiked 50 basis points. So the market algorithms had to aggressively adjust for that. We saw yen strengthen significantly and risk assets sell off so that investors could cover their carry trades, and the yen carry trade unwound, right? So we need to be mindful of that. Any hawkish surprise from the Bank of Japan outside of what the market's pricing in, or any interest rate hike outside of what the market's pricing in that leads to excessive yen strength is a catalyst that we need to be mindful of this week. All right, just to breeze through that. Then, of course, last but not least, geez Louise, like I said, this fundamental report was extremely important for you all to read and understand because every day is going to be different this week. We have earnings seasons, corporate earnings, likely to rival macroeconomics as one of this week's biggest market drivers. So right now, 4 members of the Magnificent Seven are going to be reporting this week, which are going to be our primary focus. On Wednesday, we have Microsoft and Meta, i.e. Facebook. And Thursday, we have Apple and Amazon. The market right now is no longer simply looking for strong revenue growth. Investors are seeking fundamentally different changes. For the past 2 years, Wall Street rewarded companies for aggressively investing in artificial intelligence. However, now investors want proof, i.e., that is a very important word right there. They want proof that those enormous investments are producing meaningful returns for investors, right? If we don't get that confirmation, then just like last week, even though we saw upbeat earnings reports, we're still going to see a sell-off. Alphabet demonstrated this shift perfectly last week. Revenue exceeded expectations, cloud growth accelerated dramatically, search remained resilient, but the stock still sold off sharply last week because management substantially increased projected capital expenditures while free cash flow deteriorated. We need to see underlying confirmation that those upbeat earnings are eventually going to turn into meaningful returns for investors. All right. So make sure that you guys align yourself with the rest of the breakdown on earnings reports, because I made sure to give you guys a detailistic if-then scenario for that. And so outside of that, all right, to now roll over into the if-then scenarios for crypto. The bullish case first is very straightforward. If we see diplomacy continuing to make progress, oil prices stabilize or decline, the Fed maintaining a balanced tone or leaning more dovish than previously anticipated, core PCE confirmed that inflation is easing, the Bank of Japan avoiding surprising the markets with any hawkish guidance or surprise hikes, and big tech earnings demonstrating that AI spending is becoming or beginning to generate meaningful financial returns, that is the catalyst this week that could improve liquidity conditions and send risk assets soaring. We probably see NASDAQ back above 30,000. We probably see crypto break the $2.2 trillion threshold. And so, in an environment that is risk on this week, what am I paying attention to? Starting with the total cryptocurrency market cap. All right. Right now, we are failing to break above last week's high after buyers over the weekend made a slight attempt to rally towards last week's high, coming in at about $2.25 trillion. Where right now we can see that there is a passive seller defending these highs. We had an aggressive seller break previous support here in this area, engulfing all of these buyers, creating new bearish structure underneath of the 50 EMA and below the dark pool at the $2.3 trillion threshold. We then saw a 1, 2, 3 sell delta held pattern. Here's the 1, here's the 2, here's the 3, and price made a new bearish leg to the downside, where finally we started to see some absorption. We started to see buyers play defense at the next dark pool at the 2.05 trillion, and since then we have started to make a very small recovery. But we are still operating in this bearish leg from dark pool to dark pool. And in this community, we have access to these insights, so we need to use them accordingly. That means this week, the bullish scenario still remains that buyers can defend the bottom of this range. Excuse me. So bullish scenario number one would be a pullback intraday down back into the $2.05 trillion dark pool. Buyers reaccumulating orders, defending the previous discounted area, trapping sellers, and becoming aggressive to push price back to the upside, breaking this previous bearish leg. That would then send signals that the bottom, I wouldn't say the bottom is in, but we could start to see a much more meaningful recovery on crypto prices. Bullish scenario number two, if we do not see a deep retracement back down into $2.05 trillion, then as long as we can hold above last week's low, which comes in at 2.16 trillion, then make a meaningful attempt at last week's high, breaking out of that weekly range and making an attempt to break above $2.3 trillion, breaking the previous bearish leg that took us from dark pool to dark pool, turning the $2.3 trillion threshold into support. That would also make a meaningful case for a much more bullish recovery on crypto. With our next bullish target or next bullish hurdle coming in at 2.5 trillion, which is give or take the halfway mark between 2.3 trillion and 2.6 trillion. You guys can see there is a passive seller that previously broke support here, aggressively pushing price into new low territory. Buyers then got trapped. Sellers threw up a passive defense right in between and no man's land, these two dark pools, and pushed price all the way back down into 2.3. So if we do see these two bullish scenarios come into fruition, the next hurdle to the upside is going to be 2.5 trillion, where we're likely to see this passive seller make an attempt to defend. And if we can break above that, then the next target to the upside is going to be 2.6. So lots of work for buyers to do this week if we want to see or expect a much deeper recovery on crypto prices. So with that bullish scenario in mind, taking a look at crypto, XRP first. Right now, sellers are still in control on XRP. We went over this in a previous video breakdown. So right now, we're still in this bearish leg on XRP between $1.29 and $1.03. So just like the total cryptocurrency market cap, you guys could probably coexist this rally on XRP with the total market cap, but nonetheless, we saw sellers aggressively defend the $1.29 threshold after previously breaking it here. You can see we had buyers make an attempt to defend. Sellers trapped those buyers underneath of the 50 EMA. They became aggressive and created a new bearish leg from the $1.36 threshold all the way down to $1.03. Buyers made an attempt to absorb that sell volume. They did create a buy delta held at the $1.09 threshold. They made a formal attempt to break back above $1.29, but we can see the aggressive seller that broke previous support here became passive, and that seller has now passively defended $1.29 and made a new bearish leg all the way down to $1.03. So right now we are trading in this bearish leg on XRP on the higher time frame, which means that if we want to get excited for a much more meaningful bullish recovery, we need to see these higher level dark pools overcome by buy pressure. So for now, the bullish scenario, if we can hold the $0.03799 base, we can see buyers reaccumulate orders, defend this low, start to break above $1.09 and $1.16. That would then start to make a much more meaningful recovery and a possible attempt to engulf this passive seller that is likely to defend at $1.29 yet again. If we do not see a deep retracement down into $1.03 and we can hold at $1.0959, turn that into support, break above $1.16, turn $1.16 into support, that would also create a much more meaningful attempt for buyers to try to break the passive seller that has defended $1.29 in the past. If we can break above $1.29, I personally don't think price is going to stop there. If we do see buyers engulf the seller that exists here in this area, we're likely to see a sell squeeze, which would take us up into higher prices, $1.36 being the next threshold. And of course, to the upside, if we can break $1.36, then we can start to discuss these higher level dark pools between $1.57 and $1.98, right? So real logical analysis, nothing overcomplicated. We need to see price back above $1.29 before we get excited. For now, sellers still remain in control. If at any point in time we continue to operate in this bearish environment between $1.29 and $1.03, and we break bearish below $1.03, be prepared for those lower level targets on XRP. I've been highlighting them for some time. You guys know in this community, the dark pools, they don't lie. And even if they don't get hit for months at a time, they usually end up getting hit. So if we do see price trade below $1.03 down into these lower level dark pools, the first one being 91 cents as our first overarching bearish target underneath of $1, I'm not expecting price to stay at these levels for too long. And I would not be surprised if it results in a flash crash and an instant move back to the upside. So for me, what I'm doing is I have buy limits set on multiple different exchanges and brokers with a few hundred to a few $1,000 just in case those levels are hit during Asia session or London session or something when I'm not at my computer. Just be prepared for that. So a bearish close below $1.03 and a break of this most recent local base would open the door for that bearish scenario number one. Bearish scenario number two, of course, could be an environment where we do see buyers make an attempt at $1.29, fail, sellers throw up another passive defense, defending $1.29, and we inevitably see price back down at 91 cents. Bearish scenario number three, and this is worst case. If we break 91 cents, we see a bearish close below $1.03 and a bearish close below 91 cents. That would instantly and most likely open up the door for the next drop down to the bearish target of 68 cents. That is the lowest level dark pool right now on XRP's price at time of recording. All right. So still looking to see how this week unfolds. If the risk off environment continues, I'm expecting a drop back down into at least $1.03 on XRP. And we'll see how price reacts at $1.03. If buyers throw up a defense and trap sellers and push price back to the upside, or if they give way, opening the door for that 91 cent threshold. Canton's price is not looking too good for us as long-term investors who have been waiting for these discounts. I think it looks great. But in terms of buyers reclaiming these dark pools and reclaiming their throne, I don't see that happening as of time of recording until we at least see a break above the 13,916, or just like on XRP, just like on the total cryptocurrency market cap, you see that there was support here at the 13,916. A passive seller trapped buyers who tried to defend it. They then became aggressive and created new bearish price action below the dark pool. You can see that after creating this bearish leg from A to B, buyers made an attempt to defend the 12,361 dark pool. They failed. Sellers passively defended the dark pool that previously became aggressive here, keeping price beneath the 50 EMA. And we have now created a new bearish leg from A down to B on Canton, right? So logically speaking, in order for us to see buyers back in control, we first need to see buyers defend the current base where they have made an attempt to push price back above the dark pool. As you can see now, sellers are defending it at the 12,361. So defense at this most recent base. Buyers then breaking above the 12,361 dark pool and making a formal attempt at the 50 EMA in between the 13,916 and the 12,361 would be the first indication that buyers are making a much better attempt at regaining control of the current sell pressure on Canton. If we can turn the 50 EMA into support, and then we can break above the 13,916, engulfing all of these sellers and taking out the most recent bearish leg on Canton, then that'll open up the door for a much better recovery on Canton's price, and we can start to have Zoom calls discussing and talking about higher targets. But for now, this is the most realistic expectation if we are to see buyers back in control. We need to see the base hold. We need to see price back above the 12,361, breaking that 50 EMA, turning it into support, and then making a much better attempt at breaking the passive seller that has previously defended the 13,916. If we cannot see this scenario unfold on Canton, then be prepared for much lower prices. If sellers break this most recent low, we're likely to see a nice buy squeeze. The first bearish target, of course, is going to be that 11,021 dark pool.